Hi friend, you have money. Not a lot, probably, but some. And right now, somewhere in the world, someone is using your money to buy a tiny piece of a company that makes ketchup. And somehow that's legal. And somehow that's the entire global economy. Welcome to financial markets. Let's start at the beginning. Actually, before the beginning. Before any of this existed, if you wanted a cow and your neighbor had a cow, you had two options: offer him something he wanted, or steal it. Stealing is faster but has consequences. So people invented the other thing. Trade. You give me wheat, I give you a cow. Done, but here's the problem. What if I don't want wheat? What if I want a chicken, and the chicken guy wants a goat, and the goat guy wants wheat, but you don't have a goat? Suddenly everyone's running around in circles, miserable, holding increasingly inconvenient farm animals. Economists call this the coincidence of wants problem. Normal people call it a nightmare, so we invented money. Money is just a thing everyone agrees is valuable. Doesn't matter if it's gold, paper, or numbers on a screen. As long as enough people trust it, it works. And once you have money, you don't need to find someone who specifically wants your wheat. You just sell the wheat, pocket the money, and go buy whatever you actually want. That's it. That's the foundation. Money solves the barter problem. Now everything else is just complications built on top of that. So now people have money. And some people have more money than they need right now. And other people need more money than they have right now. Which creates a problem and a solution. And also, unfortunately, a financial system. Here's the core idea. If you have extra money sitting around doing nothing, that money could be doing something. It could be building a factory, funding a farm, starting a business, growing into more money. But you don't know how to build a factory. You're just a person with some extra cash and a vague anxiety about the future. Enter someone who does know how to build a factory. They have the plan, the skills, the ambition, but not the money. You have the money. They have the plan. Put them together and something useful happens. That handshake between people with money to spare and people who need money to grow is the entire point of financial markets. Everything else is just machinery built to make that handshake happen at scale, across the whole planet, millions of times per second. Now let's meet that machinery. The first way to connect money with ideas is lending. You give someone your money, they promise to pay it back. With interest. Interest is the price of borrowing. It's the fee you charge for the inconvenience of not having your money for a while, plus a little extra for the risk that they might not pay it back at all. The riskier the borrower, the higher the interest. This is not charity. This is math. The formal version of this is a bond. A bond is just a loan with paperwork. A company or government borrows money from investors, agrees to pay a fixed interest rate at regular intervals, that's called the coupon, and returns the full amount at the end. That's the maturity date. So if a company issues a bond for $1, zero with a 5% coupon and a 10-year maturity, it's saying, give us $1,000 now, we'll pay you $50 every year, and in 10 years we'll give you your $1,000 back. Simple enough, but here's where it gets interesting. Once you own a bond, you can sell it to someone else. And the price you can sell it for depends on interest rates. If rates go up after you buy your bond, new bonds offer better deals, so your old bond is worth less. If rates go down, your bond looks great by comparison, so it's worth more. Bond prices and interest rates move in opposite directions. That's the rule. Tattoo it somewhere. It will come up again. Governments issue bonds too. US Treasury bonds are considered the safest investment on the planet because the assumption is the US government will always pay you back, whether you believe that is a personal matter. But the market mostly believes it, and that belief is what makes the whole system run. Now stack all of these bonds together. Government bonds, corporate bonds, municipal bonds, bonds from every country, every company, every type of borrower, and you have the bond market, also called the fixed income market. It's enormous, bigger than the stock market. Most people ignore it. Most people are missing something important. Equity market, the second way to fund a business is not to borrow money, but to sell a piece of it. That's equity. And that's what a stock is. When a company wants to raise money without taking on debt, it can offer ownership. Slice itself into millions of tiny pieces and sell those pieces to the public. Each piece is a share. If you own a share, you own a fraction of the company. If the company makes money, you make money. If it burns to the ground, congratulations, you're now a part owner of Ash. The first time a company sells shares to the public, it's called an IPO, initial public offering. This is the moment a private company becomes a public one. There's usually a party. The executives ring a bell. Journalists write articles. Then the shares start trading and reality sets in. After the IPO, shares trade on stock exchanges. Places like the New York Stock Exchange or NASDAQ. These are marketplaces where buyers and sellers meet to agree on a price. The price moves constantly based on supply and demand, which is really just a continuous collective opinion about what the company is worth. And here's the thing about opinions, they can be rational. A company reports higher profits than expected, people think it's worth more, the stock goes up. Logical, but opinions can also be completely unhinged. A celebrity tweets about a company. A meme spreads on the internet. People feel excited or panicked or bored. The stock moves. Not because anything changed about the actual business, but because enough people decided to buy or sell, and price is just what enough people are currently agreeing to pay. This is the part where everyone argues about whether markets are rational or irrational. The answer is both at different times in ways that are impossible to consistently predict in advance, which is either humbling or infuriating depending on your personality. Stock prices are usually talked about in terms of indices, baskets of stocks that represent a slice of the market. The S&P 500 tracks 500 large US companies. The Dow Jones tracks 30 very large ones. The NASDAQ is heavy on tech. When the news says the market was up today, they usually mean one of these indices went up. Not every stock in existence, just the representative sample. Money market's quick debt tour. Not all financial markets deal in years. Some deal in days, or weeks, or overnight. The money market is where short-term borrowing and lending happens. We're talking instruments that mature in less than a year. Treasury bills, commercial paper, certificates of deposit, repurchase agreements. These are boring by design, safe, liquid, low return. Used mostly by large institutions and governments to manage cash flow in the short term. If a company needs cash for 30 days while waiting for payments to come in, they tap the money market. Not glamorous, very necessary. Now let's go global. Because not everyone uses the same money, the foreign exchange market, also called Forex or FX, is where currencies are bought and sold. If you've ever traveled internationally and exchanged dollars for euros, you've used it. Congratulations. You are a Forex participant. You are also the smallest possible player in a market that trades over $7 trillion per day. The exchange rate between two currencies is determined by supply and demand, just like everything else. But the demand for a currency is driven by 1,000 different things. Interest rates, economic growth, inflation, political stability, trade flows, speculation, vibes sometimes. If interest rates in the US go up, dollars become more attractive because holding dollars earns you more return. More demand for dollars. Dollar gets stronger. Imports become cheaper. Exports become more expensive. Somewhere a manufacturer is unhappy about this. Currency movements ripple through the entire economy. That's why central banks pay very close attention to exchange rates, even when they pretend not to. The FX market never sleeps. It runs 24 hours a day, 5 days a week, across time zones, from Tokyo to London to New York. There's no central exchange. It's all over the counter, meaning trades happen directly between parties rather than through a formal marketplace, which makes it the largest, most liquid, most decentralized financial market in the world. Somewhere between financial instruments and actual physical stuff sits the commodities market. Commodities are raw materials: oil, gold, wheat, copper, natural gas, coffee, orange juice, soybeans. If it comes out of the ground or grows on it, it's probably traded as a commodity. And like everything else in this story, commodities have a market because buyers and sellers need to find each other and agree on a price. An airline needs oil to fly planes. A farmer grows wheat and needs to sell it. A jeweler needs gold. A chip manufacturer needs copper. All of these people need certainty about future prices so they can plan. Enter futures contracts. A futures contract is an agreement to buy or sell a specific commodity at a specific price on a specific future date. A farmer can lock in the price of wheat months before harvest. An airline can lock in the price of jet fuel before it's needed. Both parties trade uncertainty for a guaranteed price. This is called hedging. It's very sensible. Of course, other people show up who have no interest in actually receiving wheat or jet fuel. They're just betting on whether prices will go up or down. That's speculation. It makes some people rich and some people broke and gives commodities markets about 90% of their daily drama. Gold deserves a special mention. It's traded as a commodity, but it functions more like a currency and a fear barometer. When people are scared, real economic fear, geopolitical instability, currency collapse kind of scared, They buy gold. Not because gold is particularly useful for most things, but because humans have agreed for thousands of years that it's valuable. Which is either profound or absurd, depending on how much you think about it. Now we get to the part that caused a global financial crisis. A derivative is a financial instrument whose value is derived from something else. A stock, a bond, a commodity, a currency, an index, an interest rate. Anything that has a price can become the basis for a derivative. You've already met one, the futures contract. But there are others. Options, swaps. Forwards, an option gives you the right, but not the obligation, to buy or sell something at a specific price before a specific date. A call option lets you buy. A put option lets you sell. If you think a stock is going up, you buy a call option. If it goes up enough, you profit. If it doesn't, you just lose whatever you paid for the option. Maximum downside, what you spent. Maximum upside, theoretically unlimited. That asymmetry is why people love options. A swap is an agreement to exchange cash flows. The most common kind is an interest rate swap, where two parties trade fixed and variable interest rate payments. Company A has a fixed rate loan but wants variable. Company B has variable but wants fixed. They swap. Everyone gets what they wanted. The bank in the middle takes a fee. Now stack all these instruments together. Then create derivatives of those derivatives. Then package bundles of mortgages into securities and create derivatives based on those. Then insure those derivatives with other derivatives. Then convince the ratings agencies that everything is fine. That's roughly what happened in the early 2000s. And in 2008, when the underlying mortgages started defaulting, everything built on top of them came apart very fast, because no one knew exactly who owned what, or how much it was worth, or how much risk was hiding inside all those layers of complexity. That was the global financial crisis. The derivatives market didn't cause it alone, but it made it much, much worse. Since then, regulators have tried to bring more transparency to the over-the-counter derivatives world. Some would say not enough. That debate continues. Okay, we've been talking about markets as if prices just materialize. They don't. Let's talk about how prices actually form. In any market, there are two sides. Buyers who want to pay as little as possible. Sellers who want to receive as much as possible. The price is wherever these two sides meet. In stock markets, this happens through an order book. A list of everyone willing to buy at what price and everyone willing to sell at what price. The highest price a buyer will pay is the bid. The lowest price a seller will accept is the ask. The gap between them is the spread. When a buyer's price meets a seller's price, a trade happens. The market price updates. Millions of these happen every second, but not all information is the same. Some investors have more information than others. A company's own executives know things before the public does. Using that non-public information to trade is called insider trading. It's illegal. It still happens. The SEC tries to catch it. Sometimes they succeed. There's a whole theory called the efficient market hypothesis that says you can't consistently beat the market because all available information is already reflected in prices. So trying to pick winning stocks is a fool's errand. Just buy the whole market and go home. The counter-argument is that markets aren't always rational, that some investors do consistently outperform, and that the hypothesis is technically unfalsifiable. This debate has been ongoing for about 60 years, and both sides are still very confident they're right. None of this happens in a vacuum. Floating above all of these markets is the central bank. In the US, that's the Federal Reserve. In Europe, the European Central Bank. In most countries, there's one. Central banks don't participate in markets the way regular investors do. They control something more fundamental: the price of money itself, the interest rate. When the Fed raises interest rates, borrowing becomes more expensive. Companies invest less. Consumers spend less. The economy slows down. Inflation drops. When the Fed cuts rates, the opposite happens. Borrowing is cheap. Money flows. Economy heats up. This lever, the policy interest rate, affects everything: stock prices, bond prices, exchange rates, mortgage rates, the cost of your car loan, the fate of entire emerging market economies, all connected to the same dial, controlled by a committee of economists who meet 8 times a year and argue about data. The thing central banks most want to avoid is runaway inflation, where prices spiral out of control and money loses its value fast. But they also don't want deflation, where prices fall so much that everyone stops spending, waiting for things to get cheaper, causing the economy to seize up. So they try to keep inflation at around 2%. Not too hot, not too cold. The Goldilocks zone of monetary policy. Whether they can consistently hit that target is another long debate with a lot of graphs. Now let's talk about who's actually in these markets. Because it's not just you and your retirement account, retail investors are individuals like you, buying stocks through a brokerage app, small players, lots of them, increasingly powerful in aggregate. As meme stocks have demonstrated in spectacular fashion, institutional investors are the big players, pension funds managing retirees' savings, mutual funds pooling money from thousands of investors, insurance companies investing premium payments, endowments managing university wealth. They move billions at a time. Their trades move markets. Hedge funds take larger risks in pursuit of larger returns. They use leverage, borrowed money, to amplify positions. Some use sophisticated algorithms. Some take concentrated bets on specific ideas. Some sell short, profiting when prices fall. They are regulated less than regular funds and generally cater to wealthy investors who can absorb the risk. Their track record, in aggregate, is surprisingly mediocre. High-frequency trading firms operate at a completely different speed. We're talking microseconds. Algorithm scanning markets, identifying tiny price discrepancies, and trading on them before any human could even read the data. They provide liquidity to markets, making it easier to buy and sell, but their presence also introduces new types of risk and new questions about fairness. Investment banks sit at the center of a lot of this. They help companies go public. They underwrite bond offerings. They facilitate mergers. They trade for their own accounts. They advise on everything. They are simultaneously very important to the financial system and very unpopular with the general public. Both of those things make sense. Every financial decision involves risk. This is not optional. Risk is the price of return. The most basic idea in finance is that risk and return are related. Low risk, low return. High risk, high potential return. US Treasury bonds are low risk. Startup equity is high risk. This is not a coincidence, but not all risk is the same. There's market risk. The whole market goes down and everything you own falls with it. There's credit risk. Someone who owes you money can't pay. There's liquidity risk. You own something you can't sell when you need to. There's currency risk. Your investment is in a foreign currency that loses value. There's political risk. A government changes the rules. Smart investors don't try to eliminate risk. That's impossible. They try to manage it. Specifically, they try to take on risk they're rewarded for and avoid risk they're not. The main tool for managing risk is diversification. Own many different things that don't all move together. If your entire portfolio is one stock and that stock craters, you're devastated. If that stock is one of 500, you barely notice. Don't put all your eggs in one basket. This advice is so obvious it feels trivial. And yet people keep putting all their eggs in one basket. Correlation is the enemy of diversification. If everything you own goes down at the same time for the same reason, diversification didn't help you. This is what investors discovered in 2008, that assets they thought were uncorrelated turned out to be very correlated when things got bad enough. Risk hides in relationships. Markets go up, markets go down. This has been true for as long as markets have existed, and it will continue to be true. A bull market is when prices are rising. Investors are optimistic, risk-taking increases. Everyone looks like a genius. A bear market is when prices are falling more than 20%. Sentiment is dark. People start questioning everything. Some of those geniuses from 2 years ago now have podcasts about why they saw it coming. Recessions and financial crises knock markets down hard. The 2000 dot-com crash, the 2008 financial crisis, the 2020 pandemic crash. Each time people said it was different. Each time markets eventually recovered. Each time some people made money on the way down and more people lost money panicking at the bottom. The psychology of market cycles is its own field of study. Humans are systematically bad at investing. We buy high, sell low, we overreact to recent events. We follow the crowd in exactly the wrong direction. We mistake luck for skill in bull markets and skill for luck in bear markets. Behavioral economics has documented all of these tendencies in exhaustive detail. The solution everyone recommends is to ignore all of it. Buy a diversified index fund. Contribute regularly. Don't look at it during crashes. This is correct and almost impossible for most people to actually do. Here's the part where this stops being abstract. Financial markets allocate capital. That sounds boring, but it's one of the most powerful forces in the modern world. When markets work well, money flows toward good ideas and away from bad ones. Companies that create value attract investors. Companies that destroy value can't raise funding. That's the ideal. Reality is messier. Markets sometimes fund things that are spectacular, and sometimes fund things that are catastrophically stupid. They create enormous wealth and also enormous inequality. They allow ordinary people to build savings over decades and occasionally allow extraordinary people to extract enormous wealth in ways that feel disconnected from anything actually useful. Governments try to regulate markets to keep them fair and stable. Markets try to operate around regulations in ways that are technically legal, but occasionally catastrophic. This tension produces a continuous negotiation that's been going on since the first securities market opened in Amsterdam in 1602. Your money through your bank, your pension, your investments is part of this system whether you chose to engage with it or not. Understanding it doesn't make you rich, but not understanding it makes it much easier for other people to make decisions with your money that primarily benefit themselves. So, scarcity created trade. Trade needed money. Money created lending. Lending created debt markets. Ownership created equity markets. Global trade created Forex markets. Physical goods created commodities markets. Complexity created derivatives markets. All of it connected. All of it moving simultaneously. All of it reacting to the same interest rates set by the same central banks, responding to the same economic data, interpreted differently by millions of participants at the same time. That's financial markets. All of it, explained fast. If you got something out of this, vote with a thumbs up. If this gets enough likes, I'll have to make a part 2. That's how financial incentives work. I built one right into the end of this video.